Welcome to another episode of Market Brief After Hours. We've got a packed show for you tonight. It was a fascinating day on Wall Street, where a 3-day losing streak for the S&P 500 was finally broken. But the real story behind this rebound isn't just about stocks. It's about an extraordinary move by the U.S. Treasury that sent shockwaves through the bond market. Let's dive straight into the numbers. How did the major U.S. indexes wrap up today?
It was definitely a turnaround day, though we did see some of the early enthusiasm fade as the session went on. To give you the final numbers, the S&P 500 gained 0.21% to close at 7,708. The Nasdaq Composite advanced 0.16%, ending the day at 26,331. And the Dow Jones Industrial Average added about 120 points, which is a 0.22% gain, settling at 53,463. Now, what's interesting is that earlier in the session, things looked even brighter. At its peak, the Dow was up over 360 points, or about 0.7%, and both the S&P 500 and Nasdaq were up 0.7% and 0.6% respectively before giving back some of those gains.
What triggered that initial surge? It seems like everyone was watching the bond market.
Absolutely. The catalyst was a major announcement from the Treasury Department. They revealed they are going to at least double the size of their government debt repurchases, specifically targeting longer-term debt in the 10 to 30-year range, which also includes the 20-year bond. This buyback operation provided some massive, much-needed rate relief. Before this, bond yields had been marching up to multi-year highs. After the announcement, yields pulled back sharply. The 30-year Treasury bond yield, which had just notched a 19-year high above 5.33% the previous day, dropped more than 10 basis points to finish at 5.184%. Meanwhile, the 10-year Treasury note yield fell over 6 basis points to 4.637%.
That's a significant drop in a single day, and I imagine rate-sensitive stocks breathed a sigh of relief.
Yes, indeed. We saw companies like Lowe's and Home Depot, which are highly sensitive to interest rates and the housing market, both gain around 2%. There's definitely a tug-of-war happening right now. On one hand, corporate earnings and economic fundamentals still look incredibly robust, which is great for value stocks. On the other hand, we have this high cost of capital driven by elevated yields. It's a tense environment, but many analysts still see it as a very solid backdrop for equities because of that strong earnings outlook.
While the Treasury's buyback program offered short-term relief, it comes against a pretty staggering backdrop regarding the actual size of U.S. government debt. It feels like we just crossed a mind-boggling milestone.
We did. Total U.S. government debt has officially crossed the $40 trillion mark, specifically hitting $40.05 trillion. To put that in perspective, that's more than double where it stood just 10 years ago, when it was at $19.4 trillion. It only took about 4.5 years to climb from $30 trillion to $40 trillion, fueled by years of escalating budget deficits and massive pandemic-era stimulus. Just in July, the Treasury reported a monthly deficit of $432.3 billion, which is the highest monthly total since March 2021. The year-to-date deficit is closing in on $1.8 trillion. And get this, simply paying the interest on this nearly $40 trillion debt has cost the federal government about $1.2 trillion so far this year.
Those numbers are hard to fully comprehend. $1.2 trillion just in interest. Now, interestingly, when the Treasury announced this debt buyback, it didn't just affect traditional stocks and bonds. We saw a massive rally in the crypto space too. Why did digital assets react so strongly?
It was a classic risk-on reaction. When the Treasury stepped in to support the bond market, investors felt more comfortable taking on risk. Bitcoin surged over 6% to trade around $68,700. Ether jumped 11%, and Solana popped 7% to over $82. We also saw major gains in crypto-related equities. MicroStrategy led the Nasdaq 100 gainers, closing up more than 12%. Circle Internet Group and Coinbase both jumped over 9%, and Galaxy Digital Holdings was up more than 8%. It shows you how quickly liquidity expectations can shift sentiment in the crypto market.
Let's take a quick pause here. Stay tuned. Welcome back to Market Brief After Hours. Before the break, we were talking about the U.S. market's reaction to the Treasury's debt buyback. But if we look across the oceans, the global market picture was far more volatile. Let's start with Europe. How did they handle the day's macro data?
European markets were quite cautious and ended slightly lower. The pan-European Stoxx 600 slipped 0.11%. In Germany, the DAX edged down 0.14%, and France's CAC 40 was down 0.09%. On the positive side, the UK's FTSE 100 managed a 0.14% gain, and Switzerland's SMI rose 0.46%. Investors there were digesting fresh inflation data and keeping an eye on Middle East tensions and high oil prices.
And what did the inflation data show?
In the Eurozone, inflation ticked up slightly to 2.9% in July from 2.8% in June, driven largely by rising energy prices. Core inflation, which strips out volatile items like food and energy, also rose to 2.5% from 2.4%. Meanwhile, in the UK, consumer prices jumped to 2.9% in July from 2.6% in June, mostly due to a surge in household energy costs. That's the highest annual inflation rate for the UK since March. However, the UK's core inflation remained flat at 2.6% for the third consecutive month. Over in Italy, we saw their current account surplus narrow to €5,838.8 million in June, down from over €6,639 million a year earlier, as surpluses in goods, services, and primary income all declined.
So inflation remains a sticky problem there. Now let's talk about Asia, because things looked incredibly intense over there. We saw some major sell-offs.
Intense is the perfect word. Asia saw a massive bond sell-off that really slammed equities, particularly tech. In Japan, the 10-year government bond yield spiked to 2.95%, a level we haven't seen since 1996, as investors prepare for faster monetary tightening from the Bank of Japan. This sent the Nikkei 225 tumbling by 3.2%. SoftBank Group was a major casualty, dropping over 10%. They actually made headlines because they are planning a massive 1 trillion yen retail bond issue, the largest in Japanese history, specifically to fund AI initiatives.
A massive bond issue right as yields are spiking. That's a bold move. What about the rest of the region?
South Korea's Kospi index, which is highly sensitive to the global tech and semiconductor supply chain, absolutely plummeted by 5.8%. Chip giant Samsung and SK Hynix fell 7.82% and 9.75% respectively, while other tech names like Midai Corp and SK Square plunged 10% or more. Over in China, the Shanghai Composite fell 2.4%, and the CSI 300 dropped 2.9% to close at 4,588. Hong Kong's Hang Seng bucked the trend slightly, gaining 0.1%, while India's Sensex fell 0.4% and Singapore's STI slipped 0.1%. Australia's ASX 200 lost 0.2%, marking its sixth straight day of declines. The bright spot was New Zealand, where the index rose 0.5%, supported by healthcare and communications.
Wow, a nearly 6% drop in South Korea is massive. Let's pivot to the currency markets, because we saw some very sharp technical moves today, especially with the euro and the yen.
Yes, the foreign exchange market had some dramatic shifts. Let's start with the euro. The Euro-USD pair surged 0.87% to close at 1.1677, trading between a low of 1.1570 and a high of 1.1679. This was a very strong bullish move that cleanly sliced through its key moving averages. It closed above its 50-day simple moving average at 1.1470, its 100-day SMA at 1.1570, and, crucially, its 200-day SMA at 1.1629. This suggests a real shift in momentum, turning the short-term trend positive.
And what about the British pound? Did it follow a similar path?
It did. GBP/USD extended its rally, closing up 0.57% at 1.3609 after hitting a high of 1.3631. It's trading well above its key moving averages. The 50-day SMA is at 1.3386, the 200-day SMA is at 1.3419, and the 100-day SMA is at 1.3423. This keeps the technical picture very constructive for the pound.
But the big story might be the yen, right? We've seen USD JPY make some aggressive moves lately.
Absolutely. The USD-JPY pair plummeted 0.91% to close at 158.14. It actually broke clean through key support at its 200-day simple moving average, which sits at 158.25. It's also trading well below its 100-day SMA at 159.97 and its 50-day SMA at 161.02. This aggressive selling suggests that sellers have taken firm control, reversing the medium-term uptrend we saw earlier this year.
Fascinating. And what about commodities? Gold and silver had absolute monster days.
They really did. Gold surged an incredible 4.07% to close at $4,510, trading as high as $4,512. This massive expansion candle pushed gold decisively above its 100-day SMA of $4,390 and its 200-day SMA of $4,495, leaving the 50-day SMA way behind at $4,158. This is a violent trend reversal to the upside. Silver followed suit, rallying 4.85% to close at $66.38, breaking past its 50-day SMA of $61.32, though it's still capped by its 100-day SMA at $68.63 and 200-day SMA at $71.04.
And oil? With the Middle East tensions you mentioned, how did crude react?
Oil prices rose more than 1%. Brent crude futures ended 0.7% higher at $91.62 a barrel, while U.S. West Texas Intermediate rose 1% to settle at $85.83. This was driven by the UAE suspending economic transactions with Iran and ongoing slow shipping through the crucial Strait of Hormuz.
Let's wrap up with some of the individual stock stories that caught our eye today. There were some massive winners and losers in the corporate space. Who stood out?
On the positive side, Estee Lauder was a standout, closing up more than 16% after reporting fourth-quarter net sales of $3.63 billion, which beat the consensus estimate of $3.55 billion. We also saw Marvell Technology jump over 9% after expanding its chip development partnership with Google. This deal includes a warrant allowing Google to buy up to $12.2 billion of Marvell stock.
And there was also a huge move in the biotech space, right? Moderna?
Oh, absolutely. Moderna had its best day on record, soaring about 177% after an experimental skin cancer vaccine they developed with Merck showed major success in a late-stage trial. Merck shares also jumped more than 12% on the news, which really helped support the Dow.
On the flip side, who had a rough day?
La-Z-Boy took a heavy hit, closing down over 17% after forecasting second-quarter sales of $475.7 million, which was way below the consensus estimate of $537 million. Also, we saw a pullback in AI-related tech stocks. A Wall Street Journal report suggested that OpenAI's second-quarter results disappointed investors because while revenue grew 18% quarter-over-quarter, their losses expanded too. This dragged down chipmakers for a second straight day. Broadcom fell over 4%, AMD shed nearly 4%, and the iShares Semiconductor ETF closed down over 2%. Seagate Technology led the S&P 500 losers, dropping over 7%, while Western Digital and Lam Research both fell over 6%. Finally, Nebius Group fell over 9% after announcing a massive $4.5 billion convertible notes offering.
A truly dynamic day of trading, from massive macro interventions to dramatic stock-specific moves. And that's all we have for you today on this episode. If you find this useful, please follow Market Brief After Hours.